Okay, I had one for a request for consolidating something on the financial sector. So, what do you need to know about the financial sector? If you look at the specification, two main things. One, the size and influence of the financial sector. Yeah, so how big is it? What is it? Why does it matter? And then, secondly, related to that, why does it need regulating in terms of creating financial stability? And one of the roles of the part of monetary policy, and one of the roles of the Bank of England is to create, on the one hand, what's called monetary stability, which is to control inflation. And we talked about that elsewhere. And the other is to create financial stability, which is to ensure that the overall financial system doesn't break, that it remains there and functional and stable, and so that we can all continue to use banks, use our cards, be able to buy food and not have to go hunting rabbits with sticks. Yes, it's the idea that the system as a whole remains stable. So what's in the financial sector? Essentially, it's anything really to do with money. So inside inside the financial sector, obviously, on the one hand, you just got ordinary banks, and high street banks. You've got central banks, like the Bank of England. You've got pension funds. More interesting to me than to you. You've got insurance companies. You take out insurance on everything. Travel. For you, perhaps car insurance, housing. House insurance. All those sorts of things. Linked to banks, you've also got building societies which do the same job. And linked to all of that, you've also got credit card type people. So you've got credit card. So some banks issue their own credit cards, some don't. You've got therefore the whole Visa and MasterCard network. You've got forex dealers. You've got the stock exchange, where companies can raise finance. So you can see that there are probably other things that I've forgotten, but you can see that there are a hell of a lot of different things, that are influenced by this financial sector or a part of it. So if you want a sense of how big is it, there was a report commissioned by the government about 2 or 3 years ago, and it said that around before the pandemic, the financial sector in the UK it was pretty large, so it employed about 1.1 million people. And that's when the UK total employment in the UK is sort of 33, 34 million, something like that. So that's quite a lot of people. It's sort of 3 to 4% of the labour force, but it contributes 7%, a little bit more, to the UK's GDP. So it's quite big. But that's comparable to, it's comparable, to be honest, to other large economies as well. So Australia, the US. It's nowhere near the size of Luxembourg, which is in relative terms 2 or 3 times as big. It generates quite a lot of tax revenue for the government. About 11% of the government's tax revenue comes from the financial sector, one way or another. It's not really corporation tax. That's things like income tax, national insurance, VAT, that type of stuff. That 7% of GDP back in 2019, about 130 billion, probably a bit more now. And it's also a big net exporter. So there aren't many sectors in which we have a trade surplus, but the financial sector is one, and it contributes about 50 billion quid, in net exports. So it's a large sector. So why does it? So its size and significance. We'll talk about its significance as an individual level, but it clearly has a significance, at a kind of overall macro level, because of the way in which it's contributing to jobs and tax revenue. So why do we need to regulate it? Underpinning all of the financial sector is that it is inherently risky. Basically, what they're doing is, they take your cash and they take the cash from customers and they lend it to other people. Yes, essentially, there is always what's called a liquidity risk. If more than about 1% probably these days of customers all decide they want their money at the same time, the bank can't pay you back, because they don't have it. Now, normally nobody wants that. Nobody wants money. I mean, who goes and takes money out of banks these days? Nobody. Yeah, so therefore what they do is they lend most of them, all of the money, yeah, and pretty much, yeah, that they've had in the form of deposits. Often they lend it, you know, in kind of relatively safe activities. Yeah, so they're lending it to people to buy houses and so on and so forth. That's relatively safe because, yeah, if people don't repay, then you sell the house. But sometimes they'll engage in riskier activities. Yeah, so they'll buy shares, kind of lend to corporations for speculative purposes and so on and so forth. So there is inherently a risk always, to the banking sector, which is if there is a sudden shock, and lots of customers want their money all out at the same time, then there is a problem. Secondly, as we just said, it's big, and so it needs regulating because if something goes wrong, that affects a very large number of people. And when you start to look at those sectors, that we said, well, why does that matter? We've got things like the stock exchange, and kind of banking. They affect firms' ability to borrow money. That affects their ability to invest, which therefore affects potential growth. It's going to affect the extent to which AS is going to rise in the long term. Or if you think about me, so we're talking about these individual impacts now. Talking about me, my pension is tied up with a company called Scottish Widows. There is therefore, if that goes wrong, then I ain't going to get to retire. I'm not going to be very happy. So there are impacts on ordinary people themselves. Our savings, our pensions, the insurance that we take out on our homes and so on. They're all tied up with the financial sector. And if the financial sector goes, kind of gets into difficulties, then that affects the living standards of ordinary people. So those are so one is it's risky and affects us, but also we can link to that this idea that one of the reasons it needs regulating is that it is particularly prone, we could argue, to market failure. It is much more likely in the financial sector that things are going to go wrong. There's going to be a misallocation of resources. And one of the big reasons for that, there are a few, but one is that there is a huge degree of information asymmetry in the financial sector, simply because of the complexity of the products. I mean, I'm a reasonably well-educated guy. I know quite a lot about finance, but do I really know what my bank is doing? Do I really know what First Direct is undertaking, what risks they're taking on? I haven't got a clue. I have some idea of where Scottish Widows has invested my pension because I take some sort of interest in that, but a lot of people don't. So, as a result of that, that information asymmetry, bad things can happen. So, for example, kind of 4 or 5 years ago, there was a whole thing called the PPI scandal. PPI was payment protection insurance, where if you took out a loan, you could take out insurance in case you couldn't pay it back. But what started to happen is that people started simply to add that insurance on without you ever having asked for it. So you were paying for something that you'd never asked for, you didn't know about, and probably was no use to you. Because the loan process was so complex that people just couldn't understand it. They just were just given a number, this is how much you're going to have to repay, they signed it, and the job was done. And that's obviously a misallocation of resources, If I've taught you, we've come up with other examples like Wells Fargo, where the employees were simply opening accounts on customers' behalf without asking them to meet sales targets. And that links to another one, which is, there's a big risk of short-termism, in the financial sector, and that's often linked to this big bonus culture. So you can make a lot of money, very fast, earning a very, very big bonus, and that encourages you to take unnecessary risks, and you'll be focused on making profit this year rather than thinking about how you're going to make profit over 3, 4, 5 years, which in turn links to this idea of moral hazard, which is you're going to take big risks in the hope that they pay off. If they don't, well, it's not you that gets penalised. Ultimately, it's the bank, shareholders, or perhaps the government if it ends up having to bail out the bank. So that's a worry. And we also argued that there had been kind of excessive competition in the banking sector. Yeah, that again means it needs regulating. In other words, what had happened is that through the 80s there had been a lot of deregulation. And anybody who's watched The Big Short will know that, for example, the ratings agencies, which are the organisations that are in theory responsible for trying to tell a bank, whether an asset that it's thinking about investing in is safe. Those rating agencies were all competing with one another, to give high ratings. And therefore, there are some absurd statistics, like there were kind of 10 AAA rated companies in the world, like Amazon, but I don't know, hundreds and hundreds of AAA rated pieces of paper. It's like, how could that possibly be better, safer, than lending money to Apple? I mean, it's just absurd. So all we got is this idea that the market is prone to failure, and I particularly focus on kind of information asymmetry and short-termism. Information asymmetry is a very good one to use just because it's quite easy to explain. And finally, the reason we need to regulate it is to prevent bubbles. And that's we can see that there have been many bubbles in financial markets over the years. The most recent one being the housing bubble that ended in 2008. And there's probably a stock market bubble growing at the moment. There was the dot-com bubble back in the 2000s. So it's much easier for bubbles to get started in financial markets. Okay, so what regulation has been introduced then since the crisis? We've got a few things. The Bank of England has two main bits now that oversee regulation. You don't really need to know much about this. There's one called the Financial Policy Committee, another one called the Prudential Regulation Authority. You don't need to know much about these. That regulates the system as a whole. That regulates individual banks. The way the Bank of England describes it is like a jigsaw, where the PRA regulates the individual pieces and the FPC looks at the jigsaw as a whole to make sure it makes sense. They work together, and there's a variety of things that have been done over the last 10 years, some at EU level, some at UK level. One is stress tests and what are called capital requirements. And what that's saying is that banks have to hold more cash than they used to. So they can cope more easily if there is a downturn, because they've got actually more cash sitting around in the case that customers come and want to take that money out. And linked to that, there's been what's called ring fencing of customer deposits. So part of the problem in the financial crisis is they've taken your money and basically kind of gambled it on, kind of high risk financial assets. They can't do that anymore. They can lend your money, but they can only lend it into certain categories of things. There are more controls and supervision over who and how banks can lend money to. So one of the reasons that Northern Rock got into trouble, is that Northern Rock had this thing called 125% mortgage. Where if you wanted to borrow if you had a house that was £100,000, they would lend you £125,000 because the house price was rising all the time. And they're not allowed to do that anymore. And so there are more direct controls. And the government itself has guaranteed higher levels given a guarantee over your savings of £85,000. During the financial crisis, it was down at about 35. So if the bank goes bust, the government will give you up to 85,000 quid back. So therefore your money is basically safe. And because you know your money's safe, that makes the system safe. Because you know your money's safe, so you don't go and take it out. So therefore the bank remains safe. It's like a giant confidence tree. Some people have started to raise concerns that maybe there's too much regulation, that it's damaging banks' ability to compete on world markets where maybe there are less regulation in other markets. And also that banks now will only lend to safe people. So therefore small, new, innovative companies may struggle to get finance. Or, we only lend to rich people, because they're the ones that are going to be able to pay back. And maybe that in itself creates different issues.